Welcome back to the Pro Ticker Podcast, your Wednesday morning edition covering major financial magazine headlines, everyone.
Great to be here.
We're here for another deep dive, taking a look at the financial news that's making waves and, well, figuring out what it really means for you.
Exactly. Our mission today, really, is to cut through that daily noise. We're looking at articles from places like MarketWatch and Bloomberg.
Right.
And trying to understand the underlying currents shaping the market.
And there are definitely a lot of cross-currents right now. We're seeing potential shifts in trade policy, some whispers from central banks, and some really significant company-specific news.
Yeah, it feels like a dynamic environment, doesn't it? Tariffs, Fed actions, the global outlook. It's all creating a bit of tension, a bit of uncertainty.
It feels like we're on the cusp of some potentially big changes, so let's unpack this.
Absolutely. It's a fascinating moment because you've got these big macro forces like the trade situation, the Fed's moves bumping up against very specific company strategies and, frankly, challenges.
And as you said, drawing from Bloomberg MarketWatch, it's often where those two things meet, the macro and the micro, that you find the really revealing stuff.
That's the goal. Find those insights.
Okay, so let's jump right into this idea of maybe easing trade tensions. Bloomberg News had several pieces on this.
Yeah, I saw those. Like Bitcoin climbs higher as Trump seeks to ease trade, Fed tension.
And also, Trump floats substantial China tariffs cuts in trade deal. Sounds like a potential shift. What's your read on this apparent change in tone?
Well, what's interesting is the stated intention, According to those Bloomberg reports, President Trump suggested he plans to be very nice, quote unquote, with China.
Oh, very nice. Okay.
And he even floated the idea that tariffs could come down substantially in a deal.
Oh.
Well, it's quite a departure from some of the tougher talk we've heard.
Right. And Bloomberg also mentioned Treasury Secretary Scott Bessent thinks this tariff standoff just isn't sustainable long term.
Exactly. He apparently views it as something that has to give eventually for both economies.
And the market certainly seemed to latch onto this shift, didn't it? That Bloomberg piece, Chinese stocks in Hong Kong rally on bets trade tensions to ease, really highlights that reaction.
Oh, absolutely. Big rally in Hong Kong listed Chinese stocks.
Yeah.
The offshore yuan strengthened too.
So investors are clearly sensitive to any hint of de-escalation.
It's very sensitive. It's like a weight being lifted, at least psychologically for a bit. And you saw ripples elsewhere too. CNBC's European Markets Live Updates noted that European markets open higher because of these receding trade worries.
But is this optimism completely solid? I mean, we've kind of seen shifts in rhetoric before, haven't we?
That's the big question, isn't it?
The Bloomberg reporting also mentioned, China hasn't made a big official response, and there's still a lack of specifics on any deal.
That's a crucial point.
Oh.
The market's reacting to the vibe, the sentiment, but the core issues, they haven't necessarily vanished. As that Bloomberg piece, Trump floats substantial China tariffs cuts, sort of implies, there's still a ways to go between talking about cuts and actually agreeing on them. And policy can be, well, unpredictable.
And let's not forget, CNBC reported the IMF actually cut growth forecasts for the U.S. and the U.K., specifically citing the impact of the tariffs already in place.
Exactly. So those underlying economic headwinds, they haven't just disappeared because of a few friendlier comments. The damage is still being factored in by organizations like the IMF.
That contrast is really stark. You've got this immediate market bounce on hopeful words, but the IMF, looking at the longer-term picture, says the existing tariffs are still hurting growth. Makes you wonder if the market's getting a bit ahead of itself.
It definitely raises that question. And this connects perfectly to another really insightful piece from Bloomberg. CEO gloom rivals financial crisis as tariffs roil S&P 500 stocks.
Wow, rivals the financial crisis. That's a strong comparison.
It is. The article says the ratio of negative to positive macroeconomic comments from CEOs this earnings season is apparently hitting levels we haven't seen since, like, the depths of 2009.
Gosh, what's driving that level of pessimism, according to Bloomberg?
The article really points to the profound uncertainty from these fluctuating trade policies. CEOs are finding it incredibly hard to plan, to make investment decisions, when the rules seem to keep shifting.
Yeah, I can see that. Hard to commit capital when you don't know the cost of goods next quarter.
Precisely. And this uncertainty is directly leading more companies to cut their financial guidance for the year.
Okay.
And what's also interesting, the article notes, is how the market's reacting. It's punishing companies that lower their outlook, but it's not really rewarding those that beat expectations by much.
So a very cautious, defensive investor mindset overall.
Seems like it. Although you could argue this level of gloom might also create some contrarian opportunities. for investors willing to look past the immediate noise, maybe in sectors less exposed to tariffs.
Right. Interesting point. So against this backdrop, potential trade easing, but also this deep CEO gloom, we're seeing major company-specific stuff happening. Let's start with tech. MarketWatch reported Intel reportedly to slash more than 20% of its workforce. That sounds huge.
It's a massive number. The MarketWatch report suggests this potential cut, maybe over 22,000 people, is being driven by the new CEO, Lip-Bu Tan.
Trying to streamline things.
Yeah, streamlined management, apparently. And this is happening while Intel is facing, much tougher competition in that really important AI chip market.
And the trade tensions probably aren't helping either, right? China's a big market.
Exactly. The article notes that pressure, too. So you have this economic uncertainty, trade policy pressures, and then companies like Intel making these big internal moves in response.
And it's not just Intel feeling the heat in tech, is it? MarketWatch also had that article. AMD's AI story was already tenuous, and now the stock has new challenges. Sounds a bit worrying for AMD.
Yeah, that Bernstein analysis highlighted by MarketWatch wasn't exactly glowing. It suggests AMD's current AI chips aren't seen as super competitive right now.
Ouch.
And maybe more significantly, those tighter U.S. export controls mean AMD can't sell its top-end AI accelerators into China anymore.
Which was a big potential growth area.
Huge potential. So that's a major hurdle for their AI plans, definitely.
And the article suggested AMD's challenges go beyond AI. Something about the PC business, too.
Right. MarketWatch mentioned a couple of things there. First, this idea that companies might be stocking up on PC parts now because they anticipate more tariffs later.
Which could mean slower demand down the road. Makes sense.
Exactly. And second, the article hints that Intel might be getting more aggressive in the PC market, which could squeeze AMD.
So more competition there, too.
Seems like it.
Yeah.
And as a result, the piece notes that analysts have been lowering earnings and revenue estimates for AMD for Q2 and even into 2025.
Okay, let's switch to EVs. Tesla. First quarter earnings missed, according to MarketWatch and the Wall Street Journal. But the stock rallied. That seems backward.
It does on the surface, yeah. But the MarketWatch articles like Tesla earnings missed by a mile, it didn't matter, and that WSJ piece, Tesla has a deep hole to pull out of, they both point to Elon Musk's announcement.
The one about spending less time on DOGE.
Right, the Department of Government Efficiency. He said he'd spend significantly less time on that and refocus more on Tesla.
Ah, so investors liked hearing that.
Seems so. They're likely interpreting it as a positive sign, hoping for renewed focus on execution at Tesla itself. It often comes back to belief in Musk's attention.
So the market's betting his focus is a bigger deal than the actual earnings number they just reported.
Kind of looks that way.
Yeah.
The market often prices in future potential, especially with a name like Tesla that's built on this long-term disruption story. And both MarketWatch and the WSJ noted Musk is sticking to his guns on millions of autonomous Teslas by mid-2026, and he still wants lower tariffs. So that long-term vision is still very much in play.
But the WSJ article added some important context too, didn't it? About demand.
It did. It mentioned Tesla acknowledging changing political sentiment affecting demand, and also the negative impacts of the trade war on their costs and even consumer confidence.
So even with those headwinds, the stock's valuation stays high.
Exactly. It really highlights how much hope is pinned on their future in AI, self-driving, and robotics, despite the current challenges.
Okay, let's shift to retail. MarketWatch had an interesting comparison. Amazon stock is cheap relative to Walmart's. Why investors are making a mistake in their flight to safety. That's a provocative headline. What's the argument?
The core idea, as MarketWatch lays it out, is valuation. Amazon's stock has come down recently, taking its forward PE ratio that's priced to earnings, basically a gauge of how expensive a stock is relative to its profits. Look pretty cheap compared to where Amazon usually trades. But Walmart's stock has gone up, making it look kind of expensive compared to its own history.
So the flight to safety means investors are piling into Walmart thinking it's stable, but the article says maybe Amazon's the better value now.
That's the gist. The article contrasts their growth stories. Amazon's got big potential in AI, cloud computing with AWS, whereas Walmart is more about its solid consumer staples business and growing its digital side.
Different strengths, different potential.
Exactly. And interestingly, the article points out that Morningstar analysts actually have quite different price targets for them, suggesting there's real disagreement on which is the better bet right now.
Shows how complex these comparisons can be, not just about safety versus growth.
Definitely not. Need to look under the hood.
Okay, switching tracks again. Regulatory news. Europe's been active. Market Watch reported Apple and Meta just got hit with big fines from Europe. What was that about?
Yeah, the EU fined both, according to MarketWatch, for supposedly violating the Digital Markets Act.
What did they supposedly do?
For Apple, it was a $500 million fine related to App Store restrictions. For Meta, $200 million over its consent or pay model. Pay a subscription or agree to data use for ads.
Those are pretty hefty fines, though maybe not the absolute maximum they could have faced.
Right. And their reactions. The MarketWatch piece said Apple plans to appeal.
Okay.
And it also mentioned the broader context, the EU's ongoing scrutiny of big tech, which has sometimes been a friction point with the U.S., particularly under the Trump administration. They previously called it a potential non-tariff barrier.
Interesting. We also saw some different kinds of earnings news from Europe, didn't we? CNBC reported SAP did quite well.
Yeah, quite strong, actually. In their European market updates, CNBC highlighted SAP had a 58% jump in operating profit year on year. Revenue up 11% too.
Better than expected.
Exceeded expectations, yeah. Shows some resilience in parts of the tech world, particularly enterprise software.
But then another European company, Volvo, reported a sales slowdown, also via CNBC. What was the story there?
According to CNBC's reporting, Volvo's net sales shrank by 7%, and they directly pointed the finger at the uncertainty around Trump's tariffs and how that might hit global trade.
So a real-world example of those broader policy concerns hitting a specific company's results.
Exactly. Makes it tangible, doesn't it?
Definitely. And finally, let's touch on commodities. Gold prices got volatile after that news about easing trade tensions and Trump's softer tone on Powell, right? CNBC reported that.
That's right. Spot gold slid back a bit after hitting a record high. The market may be factoring in slightly less uncertainty, perhaps.
Maybe.
But interestingly, JP Morgan, also reported by CNBC, still thinks gold could go much higher, maybe above $4,000 an ounce.
Why?
They're citing ongoing geopolitical risks and the potential for stagflation if tariffs really bite. So even in commodities, you've got these conflicting signals and outlooks.
It's never simple, is it? We also had that quick note from Bloomberg about the family feud at Singapore City Developments Ltd.
Right, a reminder it's not always just about the numbers. Corporate drama happens.
And lastly, CNBC mentioned Roche planning a huge $50 billion investment in the U.S. over the next 5 years, which is interesting given the backdrop of pharma tariff concerns.
Yeah, quite a commitment. So look, pulling it all together, what today's headlines really show is a market wrestling with a lot of complex, sometimes contradictory forces.
Yeah.
You've got these little glimmers of hope on trade giving some short-term relief. But beneath that, persistent economic worries, that CEO gloom we talked about.
Yeah.
And then companies navigating this in really different ways, some facing big headwinds, others showing surprising strength.
It creates a very dynamic, maybe confusing landscape for investors. What stands out to you as the biggest takeaway for listeners today?
For me, it's just that sheer level of uncertainty, how it's filtering down into everything from CEO confidence to specific company plans to these quick market reactions.
Yeah. It feels like we're in a time where words, pronouncements can move markets instantly, but the fundamental economic reality is still kind of murky.
Exactly. It really drives home the need for you as an investor to stay informed, but also think critically beyond just the day-to-day noise. Think about the longer-term implications.
Absolutely. And it raises that question for you, the listener. How do you navigate this? How do you balance the short-term chatter with your own long-term goals? It's definitely a moment to be thoughtful, maybe review your own strategy.
Well said.
Well, hopefully this deep dive has given you a clearer picture of what's driving these headlines and maybe some food for thought as you navigate the current financial landscape.
Indeed. We tried to provide not just the what, but some of the why and so what behind the news.
We'll see you all tomorrow morning with new headlines from major financial magazines.